Everyone, it is May 12th, 2023, and you're watching the Awesome10X Investing channel. And today we'll be discussing what are the great opportunities that are available in the markets today. We'll be discussing a few commentaries on two companies, specifically Unity Software and Disney. So let's begin. Let me share my screen here. Okay, wait up. Okay, so my name is Nikki Yu, and you can watch the Awesome 10X Investing class every Friday for free. Please don't forget to like, subscribe, share, and let's discuss the US markets, specifically the Unity and Destiny today. Okay, so Unity software actually shot up last night, 30%, trading at $32. And you can see that that was quite a breakout with volume after the earnings disclosure. After seeing the stock price fall 90% from its highs, we did actually speculate that Unity software can actually benefit. And so some of us actually were hinting to buy around 25 to 27 prior to the earnings call with of course the the risk that if it doesn't go up, then it can actually break the $20 current support that was found here around November. So this is one of those growth companies that have been very much influential for all the game developers, right? So Unity Software is primarily a video game related. It really shot to the stratosphere as a very competent engine in competition with Unreal Engine, of course, for creating games, whether it be mobile games, primarily mobile games, or AAA games. This is Unity CEO John Riccitello saying that AI has been helpful for creators, in this case, game developers, to make content better, faster, and cheaper. So you can actually watch why the company is surging on revenue beat and upbeat forecast. This was in CNBC.
Joining us now is Unity.
But before we watch that, perhaps let's go through a few things. For those who don't know who Unity is, you can clearly check that it's one of the leading real-time 3D development platforms in the world. So if you're creating augmented reality experiences, you're creating a lot of game experiences, chances are you're using something affordable like Unity or Unreal Engine. So a lot of people are still using Unity for the affordability of it. Of course, it has a very large and growing user base. There's about 6 million developers. You've got a strong partner ecosystem, including the big FANGs like Google, Amazon, and Microsoft. So it's a video game engine, a development platform. In reality, a lot of people rose to the occasion to use Unity for creating video games. And so it was always associated with video game as a category. So as a multi-billion dollar industry, as the video game grew rapidly, so did the number of developers who really were paying Unity, of course, for their powerful, user-friendly game development tools. So Unity is a versatile platform used to create a wide variety of games, from simple mobile games to complex AAA titles. So this makes it a popular choice for developers of all skill levels. The affordability of Unity is, of course, a relatively is really one of the powerful reasons why it has been accessed by almost all game developers out there. Nonetheless, they actually explained that Unity is not just being used by game developers. Sometimes there are architects, sometimes there are Hollywood filmmakers who are also using Unity, and they've actually did that by buying Lord of the Rings game developer in one of those in their past acquisitions. So in their recent earnings call, this is what they actually said: the world is a better place with more creators in it. So you'll see that they didn't actually say game developer. They wanted to highlight creators because more and more creators are actually using Unity software, even the architects, even the Hollywood filmmakers, and so on. So they have actually delivered a very strong first quarter ahead of expectations. They're excited about the rate of adoption of AI tools, and they are even raising their full year revenues and adjusted EBITDA guidance ranges to a higher level. So let's just go through some of their discussions. You can see that for the first quarter 2023, their total revenues actually is about $500 million. Not so bad considering the market was actually expecting a very, very low target of about 470 million. This means that this increase was actually quite a beat. Now, net loss was actually $254 million. Again, in an adjusted EBITDA of $32 million, they actually came in ahead of guidance. So they actually beat revenue estimates and earnings estimates for this quarter, which is one of the reasons perhaps why the market was quite ecstatic, giving them quite a 12% share price reaction after seeing the results. Now, they're also expecting that for the balance of 2023, meaning the next half, they believe that they will continue to make progress in terms of their profitability. So they think that their net loss. So you can see that this company continues to bleed money. So it's not really a surprise why the shares of Unity has fallen 90%. You can see that it's been losing money every quarter unless you're adjusting it for the EBITDA gaps, right? So the net loss is quite substantial. And you can see that the only reason why people are quite happy is that although the net losses are substantial, they have been improving their gap, no? So their adjusted EBITDA. And so far, they believe that they can hit higher revenue targets for the next few quarters. This tells me that this company is going to go higher within the next few quarters, but don't jump to conclusion that it will go very, very fast, still because of those losses that still are there. So the execution will be a question for the next few quarters. We'll see whether they really are going to deliver, right? So for the first quarter revenue, they've actually said that in their Create Solutions, it's been up 14% year over year. This now includes Unity Gaming and strategic partnerships. Take note though that if you strip out that strategic partnership, Create Solutions would still be up 17% year over year, which is about $170 million. No, that's a bit low in terms of rate of growth, but they believe that revenues will accelerate throughout the year behind the additions, price increases, adoption of digital twins, and acceleration in China. So they do have a lot of game developers in China using Unity software. Take note on the growth solutions, revenue here shot up 100% year on year to about the revenue of $313 million. So you can see that adds up to your 500 million. Now, how did growth solutions grow? We can see that this one, we perform better than the market with share of wallet gains in Unity's level play. This is our mediation platform and in our ad networks. We continue to see strong engagement in games, a stable ads market compared to the last half of 2022. So you're actually seeing potential growth and accelerating market share here. We have transitioned the Iron Source ads network to the more advanced Unity machine learning AI model, and the Unity ad network is now adopting Iron Source's bidding models. So this quarter, we even celebrated several customer key wins within games. You can see that they've got a partnership with Outfit 7, the company behind Talking Tom and Friends brand, boasting about 470 million monthly average users and over 20 billion downloads. So the other partnership that is very strong is Second Dinner's Marvel's Cap, passing 18 million downloads. They also are celebrating Immortality, which is the winner in the 2023 British Academy Game Awards. Take note that for almost all of these blockbuster games, Unity gets a portion of their revenues as a percentage for every for certain milestones up on above a certain million downloads. So these you can also see that as of March 2023 in San Francisco, they had 40 mostly creator-led sessions, demos for their latest user-generated open beta, enhancements, and over 800 customer sales meetings. These led them to at least $10 million in sales pipeline and around 10,000 leads and contacts. So you can also see that they've signed up deals just this quarter with Cincinnati Children's Hospital, co-developing virtual reality-based metaverse platform to plan pediatric cardiac surgeries. Booz Allen Hamilton is also bringing digital twin capabilities for federal agencies, and two luxury watch manufacturers are now showcasing their products for their omni-channel commerce platforms. Now you can see that from an execution perspective, they've also been reducing a lot of their workforce. You can see that the company is now more streamlined, more nimble, more productive, and they have already slashed 600 jobs, reducing the number of managerial layers to make them more agile for the longer term, They're also reducing the number of Unity offices over time. So we can see that this company is planning to grow their revenues while also lessening their expenses, which really is quite a helpful combination for Unity. So what are their generative AI? They actually said that generative AI has been very much accretive to their growth and profitability and increasing actually the attractiveness of Unity software platform. You can see that Unity has been having advantages in Unity Editor, Unity Runtime, Unity Network, and the data advantage. Let's talk about these things which they highlighted in their first quarter 2023 shareholders letter. What is the Unity Editor, right? So the Unity Editor is a tool set to create real-time experiences for games. With the power of AI, they were able to allow Unity's creators to be more productive, expand the total number of creators by abstracting away the complexity of creation tool chains. So I think that the Unity Editor is now able to help creators. You can see includes creating code, animations, physical effects, sounds, and other real-time content. So there's really quite a benefit for those who are using Unity Editor. The creation process is now easier, and even then, they believe that they will continue to update and improve their applications. Now, let's talk about the Unity Runtime. Runtime is now operating at more than 4 billion devices. These are widely distributed real-time application across the world. So they're saying that they've been working on Barracuda project for 5 years, and this brings an inference engine, an important part of Gen AI capabilities for the Unity runtime. So Barracuda is now enabling creators to do things that were considered impossible up until today. So an example would be you can now populate game worlds with NPCs or non-player characters that now seem alive, capable of dynamic, responsive dialogue, which with player characters behaving in ways that will seem real, alive, and not scripted. So you're also seeing the type of solutions that this real-time runtime Unity is able to solve for their customers. Example are sample. Instead of a complex user interface, natural language is now integrating live data with simulated outcomes. What aisles of the store were least crowded at lunchtime yesterday? What were the most common options in the car configurator where users abandoned the process? So simulate the manufacturing line for 3 full shifts given last month's actuals. So really, we're seeing that Unity runtime is actually now being used not just by game developers, but a lot. So I think Barracuda is something to watch out for, and this is something that Unity has in store for a lot of content creators and a lot of their clients. So let's take a look further. Unity Network. Now, what's this? Unity Network allows and helps customers to find new users, to increase user engagement, and to build revenue per user. For over 3 years, Unity has been already using the power of neural networks to help enable increasingly advantaged systems to enable our customers in these critical areas to increase the opportunity for both the creator and for Unity. Much possibilities as well. Take note that their training data is based on a unique data set that is operating in a real-time 3D experience. It's not just an image, it's not just a photo or a rendering of a building floor plan. In fact, they've been training their algorithms in real-time 3D data sets, which gives them quite a strong due to that, it's a stronger service, an extraordinary capability, and they're able to simulate and train their engine for their own needs, reducing all the cost to acquire it both for Unity and for customers. So we're seeing actually how AI or Gen AI is really helping Unity. So it isn't a surprise why the company is even saying that they would grow their revenues back to back. If they have already grown $500 million this quarter, they believe next quarter is also 510 to 520 million, which is actually an increase of about 70% year over year. Their assumption is that the ads market would have been flat quarter over quarter, and they will continue to gain share, performing ahead of the market. This is the reason why the market was so ecstatic after seeing the guidance. They're also increasing their adjusted EBITDA from $32 million this quarter now towards $50 to $60 million, which is a significant increase compared to last quarter's 2022 negative 38 million. They're increasing the low end of their revenue guide and the low end of their adjusted EBITDA guide as well. So you're seeing actually that this company is looking to actually hit more than $2 billion. You're seeing 510 million for the quarter, around $2 billion for the year. This is why the market was quite ecstatic. And adjusted EBITDA is now going to hit from 50 to 60 to about 250 to $300 million this full year 2023. And with all those cost reductions, take note that the EBITDA margin is also increased. Take note, though, that with all those great numbers, this is something that you have to take a look upon. You should still be aware that Unity, however, will continue to have about 100 million extra fully diluted shares at the end of the quarter. So that means that in this quarter you have 380 million. You'll have actually around 480 million, which will impact the earnings per share. So this is one of the reasons why you should also watch out for Unity, and why we think Unity will have quite some resistances, whether it be at 36 or 40. While we like what's happening, we are seeing quite good growth in their revenues, customers. This must be one of the negative highlights that you should be aware of when looking at Unity further and further. You're seeing that their basic shares outstanding, what has been happening is this company has been issuing quite a lot of stock options outstanding, RSUs, restricted stock units, and then they've got some convertible notes. So you can see that that would impact, that is about 100 million share dilution. So that's 100 million is quite a substantial shares dilution for all the Unity shareholders out there. So be careful, because we do think that that would be the negative headwind. In terms of their EBITDA reconciliation, take note, this is what's happening. So you saw that there was a GAAP net loss of about $250 million. Take note, if you add the stock-based compensation expense, here's what we're talking about. These were the $160 million here. You've got these amortization, depreciation. So there's quite a lot of reasons why they're positive EBITDA. No? So it has a lot to do with these amortization of intangible assets expense and a lot of stock-based compensation expense. So some people are actually turned off seeing a lot of these adjusted EBITDA and not really like their actual net income or net loss. So just be aware that this company is not likely to hit all-time highs anytime soon, obviously, but it will actually be a bit of a trading range in my view. So Unity Software market cap today is about $11 billion. You could see that if it reaches their sales guidance of about $2 billion, then your price to sales would be about 5B. Now, in terms of their income, I guess you can see that they've been losing $250 million per quarter. It depends, and if you're gonna take a look at those GAAP net income, which is a net loss, I think that there will be net loss, but probably a narrowing of that loss. However, what you'll see is that their earnings per share, which is currently negative, since they're not earning because it's a net loss, would not be an important thing to see. So there's no such thing as PE ratio to talk about for Unity. What we're seeing simply is that this company is growing their revenues. The company, however, has quite a lot of outstanding shares. So those share outstanding, just in case you're looking at that, take note that this 350 million is now actually 380 million, and it could be 470 to 480 million sometime estimated. So you'll actually get a lot of dilution. So just be careful about that dilution for Unity Software. Okay, so again, if there's a dilution, you can see in the chart itself of Unity why, if you're a bear, actually you might want to choose to sell here at $40, given that right now at 32 it's about 10 billion. At about 40, that would be about $12 billion, right? So I don't think this will actually shoot up to the moon. It's impossible with those types of dilution shares. However, it's very clear that the market sees that a 5 times price to sales for Unity can quickly become a growth engine, given that from about $1 billion of sales, it quickly shot up to 2 billion. What happens to Unity if there is an increase in their solutions for game developers? What if their sales actually meet 3 billion even in the next couple of quarters or years? So I can see that it depends on your time horizon, guys. It looks like Unity has found quite a good bottoming out here at about $25, 24, 25, 27. However, I also agree that it will not shoot up to the moon. Of course, if it does go up, I do believe that you have to sell somewhere here at 48 to 55 or 58 if it even goes there. I'm not even sure if it will even reach 48, guys. I don't see a 50% upside for Unity despite those raising of guidance. But will it rise, say, about 40 or 36, let's say additional 10%? That one I think I can imagine because of those strong numbers that they are guiding upon for the next few quarters and for the entire second half of the year. Okay, so let's that's for the Unity. That's like my analysis, and that's what I mean. I hope that it's a quick rundown on their results, and then let's talk about more AI news. So there's news today about China that is still in the AI game. However, you can see that China's tech has to play with Beijing's rules. So e-commerce giant Alibaba actually shared with their facial recognition Sense Time, which Alibaba also is a venture capitalist investor of, are joining Baidu for releasing Gen AI products, although they haven't described this much yet. So far, the Beijing government is saying, hey, we have to have truthful, accurate, and objectives. Take note that China is very much apprehensive on what their Ernie bot of Baidu will say or what Alibaba's chatbots Gen AI would say to the citizens. You know how the establishment is very protective on what is the truth and stuff. So I think that there will be quite a lot of jitters that's gonna handle the regulation. Nonetheless, we can see that the market is very much positive when it comes to AI, and they do know that the US, the Chinese companies will of course have some obstacles, but they will not stop, right? So all the first tier players will end up as winners in their own focus area. Beijing's AI push is a sort of ad hoc rehabilitation for China's big tech. So the US model is learned from all data sets so that the system can argue one way or another. However, in China, the regulators will make tech companies potentially liable if their bots produce the wrong answers from officials' point of view. So this is really very difficult to say. Let's say you ask the China Ernie bot anything about Xi Jinping, and let's say the politics or the CCP doesn't want whatever that bot talks about online, then that's the reason why it's very hard to see how Chinese AI will really be happening in the US, in China itself. And take note that the semiconductor challenge is real. Nvidia is actually banned from selling China the A100 chip. And so they had to substitute that with A800, which is one third slower. And people are saying that slower semiconductor will make Chinese AI tech about 2 years off versus open AI space. So we'll see. Nonetheless, you can see Alibaba yesterday rose, not necessarily because of Chat GPT of China, but because Alibaba is really gonna be a sympathy play after JD earnings results was out. Plus the fact that Alibaba is gonna report their numbers next week. So JD actually was very much a beat in terms of earnings and it's also restructuring. We actually are bullish on JD and Alibaba, and so and even like Pintuoduo, as we see like China Tech already lowering their regulatory events. But the thing is, you do have to be long term here because it's very hard to say whether that $80 is already the low for Alibaba after 33% decline from its recent high of 120. I don't think Alibaba is going to go 60, but that's just my view because there's really quite a lot of free cash flows, a lot of buybacks, restructuring, IPO spin-offs within the year alongside with that Chat GPT of China hype. Okay, Baidu, of course, has their Ernie bot. That's their own ChatGPT version, which is still in trial. And Baidu, I believe, has been growing in terms of their mobile advertising front. We'll see what the earnings will be come next week. But definitely, China tech is something to watch out for as well. So far, Baidu has retraced from 160 to about 120, 118. And the bulls in Baidu are probably going to take a look at that, given the introduction also with self-driving Apollo Taxi for Baidu. Now, Google, of course, has released Bard. Definitely, you can see that strong volume after their I/O conference last night, or was it 2 days ago? Yeah, I think it was 2 days ago, about May 10. You can see that everyone was happy that Google Bard is now available for free for 180 countries already. And they're going to release Duet AI. They're going to release Duet AI with 25 products. They've got quite a lot of integration with Google Workspaces. Pixel Fold was announced, tablets. There's Google Pixel 7a. Actually, it was quite a very good conference, and I would suggest those who are watching this channel to have a look at the Google I/O Conference 2023, which was released on May 10. You can just watch it entire 2-hour video, or you can actually just check out the highlights by several tech media networks out there. But definitely, I do see that those who are long term are seeing really that Google will maintain their hegemony in the search engine format with their generative AI search experience as well as all their partners, not necessarily just Adobe. They've got partners like Chroma, they've got partners like Replit to help coders and finish those code reviews. Palm 2 was very great with it, which means pathway language models too. So, who is trained with 100 plus programming languages, mathematics, data sets. So I'd say that this is a convincing breakout to me, and this will continue to go higher to about 123. And eventually, I think that this is already a reversal for Google in terms of strength in their AI capabilities, squashing the doubt on whether they really have a competition or whether Bing is going to take their lunch away from their search engine hegemony. Now, let's talk about, last but not the least, Disney. Disney stock tumbled, one of the largest drops over, I don't know how many years already, but there's a real reason why Disney is dropping about 9%. It fell about 8.7% last night, even after Disney stock has already fallen from its peak of about 180s or 170. So you can see that Disney today is trading at about $90. So why? Okay, the Wall Street Journal actually wrote that streaming losses are spooking investors. I'm going to read to you a few things here. Traditional television business is declining sharply, and the streaming segment is expected to be a long way from achieving profitability. Despite this, the drop also of Disney sharply reducing losses in its streaming business. They lost about 300 subscribers in US and Canada, and this was also further sliced due to the cancellations in India. Total subscribers of Disney Plus is now down by 4 million at 157.8 million. The projections for continued subscriber softness for Disney Plus in the current quarter, as well as lower marketing, were weighing on subscriber counts. So some people are really expecting that because Disney Plus is now more considerable in their profitability, that some analysts are expecting further declines to their Disney Plus subscribers, and lowering marketing expenses definitely helps them on the free cash flow side, but really will make a streaming division. It's like a question mark for the analysts. I'll explain my different take here. All right. But let me just read to you further first the analysis of the bears. The bears say that okay. Take note also that during this earnings call, Mr. Bob Iger said that Disney is now going to make Hulu available within Disney Plus. So it's going to be just a one app experience. You don't need to download Hulu separately with Disney Plus. But these Disney Plus, ESPN Plus will become available to you as a standalone option. So take note that analysts and UBS were quite, at least they're a little bit happier with the fact that Hulu will just be combined with the streaming platform. Take note that 1/3 of Hulu is owned by their rival Comcast. Comcast is the owner of CNBC, Universal Studios, and the like. So Disney said it has begun to have negotiations with Comcast to actually continue to um, to combine Hulu within Disney Plus. So that would give them savings. And take note that for this year, Disney said they will be trying to be more cost efficient, and they're saving about $5.5 billion, if not more, in terms of costs. Let me read to you the highlights in the earnings call that I really liked upon listening to Bob Iger and the team. So, our new organizational structure is returning authority and accountability to our creative leaders, which means we're going to be more efficient, coordinated, and streamlined approach to our operations. The cost cutting initiatives, we are on track to meet or even exceed our target of $5.5 billion. So you're seeing actually that the company's very much looking at cost cutting initiatives rather than revenue growth. This is the reason why they increased the pricing for Disney Plus, even if there was quite a 4 million subscriber drop. Actually, I agree with Bob Iger that the 158 million subscribers today versus the 163 million subscribers before, it's just a little bit short. It's just a small thing in terms of millions of subscribers dropping, and it's actually, as he said, de minimis in terms of drop versus the price increases that they've done. So I'm very optimistic, just like Bob Iger and team, about the direct-to-consumer business longer term. In fact, franchises, robust library, this is a significant differentiator in this space. They actually were congratulating their rival Comcast or Comcast, which is Universal, right? So Universal, Illumination, they were able to hit the jackpot with Nintendo's Super Mario Brothers. So and I believe Universal Studios is the one that is creating theme parks for Nintendo's Epic World in Hollywood and Florida, etc. So in some ways, it just tells you that the industry loves to watch movies, and therefore Disney, being a long-term leader in movies and content creation, should benefit the fact that people love to go to the movie houses as long as there's great content to watch. So they did say that our path forward in streaming is that we do have a number of clear opportunities to further position our direct-to-consumer business for success. So one of those steps is to actually make a one app experience. I think this is correct. They're going to incorporate Hulu content via Disney Plus. And while we continue to offer Disney Plus, Hulu, and ESPN Plus as standalone options, we're beginning to roll out this one app offering by the end of the calendar year. Take note too that they are now drilling down on all the details when it comes to their pricing. Over 40% of their domestic advertising portfolio is addressable, including streaming, which we expect to grow over time. I'm seeing that they're actually doubling, tripling, quadrupling down, and they're very bullish on programmatic advertising and ad tier support. So I really believe in that, the way that we've seen how Netflix ad support has been doing quite well. YouTube, which is ad supported, has been doing well. So we're actually entering the line of digital programmatic advertising, and looking at Disney is actually buying a company that is going to be a leader in direct to consumer streaming, earning and advertising revenues, as more and more advertisers would definitely want to show their advertising programmatically. So right now they have 5,000 advertisers across their streaming platforms, with over a third buying programmatic advertising today. So they are seeing that this is that growth. In addition, we plan to add our ad tiers on Disney Plus in Europe by the end of this calendar year. So you're seeing actually that they haven't been, so as they said, they've only just began to scratch the surface on what they can do with advertising on Disney Plus. So I think that is going to take time. It's going to take about 3 to 6 months further, as these will come out end of the calendar year. But definitely these pricing changes and ad-free tiers is going to reflect the better value for their content offerings, right? So they're optimizing their pricing model, rewarding loyalty customers, reducing churn to increase their subscriber revenue for their premium ad-free tier. while they're also driving growth of subscribers for the lower cost ad supported options. I think that for those who are cheapskates out there, you will go for the low cost ad supported option. It's not so bad because they're able to use and enable to amortize their content costs through legacy platforms. And then we're rationalizing, they said this, rationalizing the volume of content we're creating and what we're spending to produce our content. I really like those terms, content, cost rationalization. So really, we're seeing Disney is now very much in the game of efficiency. If Meta has been doing well in cost cutting, so does Disney. So Disney is also addressing, evaluating profitability potential, the total addressable markets, the ARPU prospects, the strength of their content, the advertising potential, and they're going to perfect their pricing model. So I'm seeing that there will be potential increases in Disney Plus subscription. If you're a Disney subscriber, chances are there will be some inflationary price increases within the next couple of quarters. Yeah, so you can see that this is their Disney Plus core subscription. Not much, right? So there's still okay. You've got growing modestly, about 105 million here. Their core ARPU, though, their average revenue per user increased by 70 cents due to simply an increase in the retail pricing. Now you can see the Hotstar subscribers, there was a decline here, but take note that Disney Hotstar decreased because of being a lower tier segment. So this is the reason why total Disney Plus subscribers, global ARPU actually increased from $3.93 to $4.44. Disney Plus Core is now $6.47, giving it so much room to grow. This can go $9, $10, right? And Disney Hotstar, which is a very, very small segment, you can see that this is just a 59 cents thing. So the fact that Disney is concentrating more on their core offerings and increasing more into higher ARPU segment tells me that Disney Plus is going to be very profitable, although they don't know the timing. My guess is that within a year, they will figure this out. So those who are long-term investors should look out for these numbers, especially the global ARPU. That's why I also agree with Bob Iger that the price increases were very much a value play. You can see that the business of Disney Plus is a very price elastic business, wherein you can increase the pricing by 10% and not really lose your subscribers, right? So from a quarter two result for fiscal 2023, it's very clear that their revenues, $21 billion, income has grown, total segment, you can see that their diluted earnings per share, although there's been, it's actually still okay. I would say that the decline that the market has been attributing is probably just due to the streaming losses, but I see it a very small thing. Now, in terms of the parks, experiences, and products results, you can see that their domestic parks so far, operating income increased 10%. So domestic parks went from 4.9 to about $5.6 billion here, driven by post-pandemic recovery, cruise line, some real estate gains. Then their domestic parks also grew in spending despite cost pressures and inflation. So they were able to really still grow. You can see that not bad in terms of revenue and income. For international parks, this has grown quite magically from zero point 0.6 to 1.2. Of course, this brought about by Shanghai, Disney Resort, Disney Paris, and then Hong Kong Disneyland. So these have been all open. So that's been a good thing. So domestic and international. So this is still a largely domestic business when you think about the Disney brand. It's still mostly in the US. But definitely the opening up of China and Europe did help them, right? So this was a good growth, I can see. From 4.9 to 0.6, then consumer products. So that's where your growth comes in. And that's where your operating income in terms of your experiences and product results are. So they have been saying they're seeing also expansions underway for their international. So for Paris, they're actually they've been happy with the resounding success on Avengers Campus. And then they're going to include a Frozen-inspired land in development for Disney Paris. For China's Shanghai Disney Resort, they're going to open a Zootopia-inspired expansion. And then the world of Frozen is going to be expanded in Hong Kong Disneyland by second half 2023. In Tokyo, Japan, which is celebrating 40th anniversary, Disney's opening Frozen Kingdom, Rapunzel's Forest, and Peter Pan's Neverland in the coming year. So there's really a lot of expansion that Disney's doing. And they've also removed the need for additional reservation for guests with date-based tickets. So that's actually important that Disney has been listening and the feedback from customers. And they make the most sense to make their capex investments in the future. So I'm actually bullish on the fact that Disney knows how it's gonna lead for the next 100 years, just as it has been doing for the last 100 years as well. So we can see that they've got a lot of theatrical releases. One of the things that I really like in the earnings call was Bob Iger substantially talking about widening the delta or the change between the ad-free service and the non-ad supported service. So the obvious reason is because of the ARPU potential of the ad service Disney Plus. So digital advertising is so attractive. We're seeing actually that Disney's gonna really fight and give Netflix tough time in terms of the ad-free business. Then of course, they've one of the things that they've of course realized is that they've launched Disney Plus in many very low ARPU markets. I think that they will stop marketing a lot in India or in smaller markets. They will prioritize the more income spending markets like US or Europe. So I'm seeing that they will actually reduce their growth expenses in marketing for India, Hotstar. So one of the things that I really like from Disney's earnings calls was they really reiterated the pricing power for Disney Plus. You'll see ARPU growth. You'll see perhaps some declines in the millions of subscribers for Hotstar. But then again, they'll widen also the ad-supported service versus the non-ad services. They do see the same thing as everyone. There is substantial growth in digital programmatic advertising. And what I really like about them is that they are very much on target in their cost rationalization and reorg of the company, which is the reason why Disney has been cutting quite a lot of employees and restructuring further and farther. So some people are also saying that in the second half of the year, they're saying, okay, there might be weaker growth numbers. There is, of course, the headwinds on new union agreements about further inflation. But I see that one of the bright things is, of course, the strength in international. You saw the increase from zero point 0.6 billion to 1.2 billion year over year. You saw that Disney is on track for good free cash flow because of that $5.5 billion reduction in costs. So right now, actually, where's Disney seated at? It's $92. I don't think it's gonna go up anytime soon unless everyone's like long term out there. In the short term, I think Disney would languish in the next 2 months or 3 months. As they said, Q3 2023, you'll still have impairment charges. Nonetheless, I'm very bullish on Disney long term. I agree with the franchises, the pricing power, the necessary restructuring that's happening. And you can see that there is quite a good support here at $80. And any dip at 80 is definitely something for me to watch a buy for Disney. People can sell 80 puts, take the premium strikes there for the next 3 months. I do believe that this is not going anywhere anytime soon. It's not going to like break out because of that earnings number. In the short term, there's still a lot of restructuring and reorg that has to happen. Those cost rationalizations, we have to see that. Plus the fact that they've already spent already for 2023. So you can see that from their table, guys, they've already spent, right? So they're now just gonna reap the benefits of whatever these content spends were. Little Mermaid, The Boogeyman, Indiana Jones, Dial of Destiny, Haunted Mansion, The Marvels, Wish. So I think that what's the beautiful thing would be around 2024 for Disney. So if you're really long term, yes, there's quite a lot of expansions in Disney. Yes, it still remains quite a great managed company with Bob Iger in the helm, but don't assume magical. I think after reading the results, listening to the earnings, I think that Disney will probably be, it won't outperform for the year, but it's a well run business. So cost reorg is important. I think that they're on the right track. The strategy is correct. Spend less, increase the pricing correctly, rationalize where the price increases have to be. Free cash flows are going to be wonderful for Disney still. So I'd say that it would be great to buy. No need to hurry, no need to chase. I think you have about next 6 months or next 3 months to just accumulate this company, hopefully less than $90. So 80, 85, 88. If you can get it below 80, even better. So that's how I'll approach Disney. So I hope that you learned something in terms of earnings results, and see you again next week for a bunch of more stock market updates and so on. Thank you very much, and bye bye.